There we go. All right. Good morning, everyone. My name is Eleanor Chatterton. I am a librarian at the St. Louis Public Library, and thank you for joining us today for this program on small business financials with the St. Louis Small Business Development Center. I will be sending out a link to a recording of today's program once we get that up on the library's YouTube channel. And at the end, when I say goodbye to you, I will pop in a link to our next program in 4 weeks on June 3rd about starting and managing a business, the first steps. But today we are talking about financial management and understanding those basic financial statements. Our speaker today is Amina Abdul Malik, who is a business counselor with the Small Business Development Center. She specializes in startups services and business plan development. And I will just turn it on over to her.
Thank you so much, as always, Eleanor. I always like to start off all of my presentations here with the library and let everyone know about all the valuable resources that they have for you for small businesses. And Eleanor will tell you a little bit about some of those resources at the conclusion of the class. But thank you all so much for joining us this morning for Focus on Financial Management. Today, we are going to be going through the essentials, that primary information you need to understand to better navigate your business's financial information. We're going to talk a little bit about some of the basic financial statements today, some of the basic financial ratios that will help you have a better understanding of how your business is performing financially, and maybe even how to navigate your business's finances a little bit better as well. Before we get started, Eleanor always gives me such a beautiful introduction, but yes, my name is Amina Abdul Malik. I am a small business development counselor for the St. Louis Small Business Development Center. Let me ask you all really quickly, has anyone, before I let you all introduce yourselves, has anyone heard of the Small Business Development Centers as a whole? Feel free to type in the chat if you don't want to unmute your mic, or feel free to unmute your mic as well. But has anyone heard of the SBDCs? Okay, if not, the Small Business Development Centers, we are a nationwide program of entrepreneurial support centers. So we operate around the country and support entrepreneurs like yourselves who are looking to either start or grow a small business. So we assist with things like today, training classes. We assist with helping you understand or create financial statements, do financial analysis for your business. But we also help with things like registration, marketing plans, business plans, and getting access to loan capital. And on top of that, we also partner with a lot of the other small business support organizations that you may hear about locally, such as the Women's Business Centers, the Veterans Business Centers, and of course the SBA directly. So that's kind of just a little bit about what we do. We offer one-on-one counseling and training. So after class, you will also have my contact information to then set up a one-on-one appointment as we to maybe further discuss some of the things we're going to learn about today. But I like to get brief introductions from everybody. We have a little bit of a smaller, intimate class. So I love if anyone, if we would be able to get some introductions, if you would just be able to share your name, what type of business you have, or what your business idea is if you're not already in business and you're just starting off, and then what you're maybe looking to gain from the course today. And if you are on mute and don't want to unmute, feel free to also type in the chat. But if anyone would like to unmute, I was going to start with the first name I see here, which is Glorious, which I love that name already. There we are. Hey there.
Good morning. My name is Glorious, and I live in American Samoa. It's 4 o'clock in the morning here, and
oh, wow.
I work. I work for a contractor, electrical contractor, and I basically do everything in the office, keep the books, and I just wanted to understand. Have a better understanding of the financial reports, and so I can help out in that way. I I help, file the taxes and do the payroll, everything, basically everything. So I just want to have more information on what I'm dealing with so I can, have a better understanding and do my job like better and more accurately. So yeah, that's why
Okay.
I signed up for the training.
Well, thank you for joining us, and I definitely think with your background and your position within that company, that you'll get a wealth of information. We're going to definitely talk and learn a little bit more about the two most or primary financial statements that you'll see used by a small business. So thank you for that, Gloria. And then I see
Thank you
Rosalind has
for
typed in the
this.
chat. Oh, no problem. I see Rosalind has typed in the chat that she has an online travel business that she is looking to get some assistance for and learn more about financial, how to keep her business financially healthy. So thank you for that, Rosalind. Megan?
Yeah, hi. So my partner and I started a group therapy practice, an LLC last year, and so we are just trying to grow and get it going. And I've been doing the bookkeeping, but it's like trying, it's one thing to do stuff for myself, but to add stuff for my partner, and then also like if we want to potentially take in other people into the group practice, I want to make sure that the money and payroll and all that stuff is all like, you know, very, very clear. And right now it's like it's so confusing to me. So, and especially like now as we've gotten into taxes and things like that, it's really made it very clear how confusing some of the stuff is with multiple people. So I want to have a better understanding of how to manage this well.
Well, thank you so much, Megan. And you are completely correct. When you are a small business owner and you have a partner, that adds a little bit of complexity already to the financial situation. And then with it being a group therapy practice, you have taxes involved in when you want to hire employees, you need independent contractors or employees, what those wages look like, what are the ramifications of hiring those employees. So yes, you are, and what I will say is understand that it will always be a work in progress and a group effort with that type of thing. So you learning this information today is just going to help compound on everything you already know. And you will be using a bunch of different tools to make that financial situation work. So and we'll talk about some of those tools and the options you have for managing finances kind of in part of the presentation. But thank you so much for that introduction, Megan. And then I think last but not least, I have Ash.
Hi. All right.
Hi there.
So I have a background as a dietitian, and I run an online group wellness program for performing artists. And there hasn't been much bookkeeping yet, but I'm not looking forward to when there is. So I wanted to
no one is looking forward to bookkeeping. But when you have a better understanding of bookkeeping and managing your finances with the small business, you'll feel more empowered to then go and do other work on the business when you know that structure is there. So you are in the right place. Thank you. And you said you manage a performing arts
wellness program.
Say that one more time. Okay, got
an
you.
Online group wellness program. Yep.
Gotcha. Online group wellness program. Okay, well, thank you all for those introductions. We're going to go ahead and jump right in. The objectives today, we are going to be learning about key business information that comes from two different financial statements. Your profit and loss statement, which you might also hear called an income statement. So those two terms are interchangeable in the business world. Typically, you'll either hear profit and loss or you'll hear income statement. And then we're also going to learn about the balance sheet. On top of that, we're going to learn about the key financial ratios that there are that give us an indication of your business's financial health in different ways. And we use these financial ratios that we're going to learn about today to help you all make better business decisions. So that's kind of our itinerary of events. And while we're also going to talk a little bit today about the two different types of accounting systems. We have cash accounting and accrual accounting, okay? So we're going to learn a little bit about the pros and cons of those, and then we'll go a little bit into a brief case study, learn about those financial ratios, And then I will have you all out the door, the virtual door, to take this information back to your business to start analyzing and using this information. So let's learn and talk about some of the financial statements that you are probably already using. And let me ask this, and feel free to type it in the chat or just shout it out. Those of you who are doing a little bit of bookkeeping right now, are you all already working with these profit and loss statements and balance sheets already? Or are you all using a more informal spreadsheet or type of process for your financials right now?
I'm using my own spreadsheet of my attempt of designing what I think is a profit and loss statement, but I've never actually
so
seen
you have
profit
your
and
own
loss
profit and loss.
statement.
Gotcha. So you didn't know what you had created, but you've essentially created your own informal profit and loss. And most of the time, when you're starting off, that is the case. So you're already doing a great job by creating your own foundation. So that's the great first step, to create your own informal process. And that's usually where your financial management starts, is creating some type of informal process. So you all are doing already great. So there's a few different ways that you're sourcing your financial information. So when you're looking at the financial makeup of your company, you're going to start by looking at something called a chart of accounts. And with a lot of small businesses, your chart of accounts is not going to be a very, very large list, but your chart of accounts essentially just defines what type of accounts your business is making money from, or revenue from. So you can almost kind of see your chart of accounts as different business divisions if you had those. But typically for small businesses, you're not really going to worry too much about having a chart of accounts. That's going to be more for those larger corporations that have a lot of different types of divisions. But most of the time, you do have a general ledger. And so a lot of times I tell clients, when you're first starting off, at least in order for you to keep up with all of your sales or transactions or all of the ways you're making revenue, you want to have a general ledger, or somewhere that has a summary of every financial transaction that has taken place for the business. And you want to go ahead and have that general ledger organized in terms of type of transaction, okay, or type of account. So all of your sales go on in one bucket. All of your utilities, all of your salaries go in one bucket. So your general ledger is essentially just where you list all of those transactions and group them by the different types of transactions they are. Now, from the general ledger, you create these different financial statements, as well as you get this different type of financial information. So from the general ledger and the chart of accounts, you get your profit and loss statement, you get your balance sheet, you're able to calculate your financial ratios, and you're also able to create a cash flow statement. Now, we're not going to talk about the cash flow statement today. I know that Eleanor and I are working on scheduling for the next few months. And so we do have a follow-up to this class, Eleanor, that we can probably discuss following up with, that goes a little bit more in depth into some of this information. But so we won't be talking about the cash flow statement, but that is another key financial piece of information that you will need at a certain point. So after you come up with a general ledger and get all that information, you are kind of in the first part, or that introductory part, of the financial management cycle. So you managing your business, I always tell my clients that you're wearing so many different hats as the business owner. Not only are you the owner and the face of the brand, you're also the marketing manager. You're also, in some ways, the accountant when you're just starting off. So because of that, you want to have a clear understanding of what your financial management cycle looks like for your business. So if you have already been making sales or revenue, you can start by documenting your past performance, okay? And documenting your past performance means putting all of that financial information and creating those profit and loss statements and balance sheets, okay? Then after you have documented your past performance, then you can analyze that past performance and take the information from the profit and loss statement and the balance sheet and use that information to go ahead and calculate your financial ratios, okay? as well as your cash flow statement. So after you document the past performance and you're able to analyze it, then you're able to circle back and start predicting future performance for your company. And that is a matter of creating a new budget, creating something called a pro forma statement. When you hear the word or the term pro forma, all that means is not a progression, excuse me, an estimate. So your pro forma statement is just another way to say your financial estimates, okay, or what you anticipate to happen in the future. So when you're looking at a profit and loss statement and a balance sheet, they are showing you a few different pieces of information. So your profit and loss statement is showing you everything a company, what a company sold and what a company spent over a period of time, okay? So your profit and loss statement is essentially that. It's going to show you how much a company made and how much a company spent over a period of time, usually over a year. And then the profit and loss statement will either show you if your company has profited or lost, okay? Now, the balance sheet is different than the profit and loss statement because the balance sheet shows you your financial information for a company, first of all, at one given point of time. And what a balance sheet is showing you is everything that your company owns and everything that your company owes at a certain point in time. Both of these statements document past performance, but one statement is going to be based on the company's spending and the expenses, and the balance sheet is going to be based on what the company actually owns in terms of assets and what the company owes in terms of liabilities. This is one of those older presentations, so I apologize, where it gives, it still has the animations for each line. I'd much rather it just put everything on the slide, but so I apologize if you see me clicking. But this right here on the right side of this slide, you have an example of a profit and loss statement. And this is an old statement. This looks like it was back from the year 2004 for a company called Computer Solutions. So let's kind of go through this a little bit. And take a look at what we can see on this profit and loss statement. So if you all have been already creating informal spreadsheets, some of this information probably looks a little bit similar to the type of information you've been capturing already. Now, at the top of your profit and loss statement or income statement, you show all of your net sales or all of the different places or ways that you are making revenue. If you have 3 different revenue streams, let's say, Rosalind, with your travel company, you make money both from subscription services. You sell a subscription package where your customers can subscribe to you and get access to exclusive travel information on a monthly basis. But then you also sell your vacation packages as well. You would report those 2 different revenue streams separately, and that would give you a better indication of how much revenue is coming from those different sources. In this simple example, Computer Solution is only listing one revenue stream. It's just all in one line, and it's net sales there for $628,000, okay? After you see the total income on a profit and loss statement, if you are selling a product or there is some cost involved in selling what you are providing, you're going to have something called a cost of goods sold. Typically, you have cost of goods sold when you are selling a product and not a service. Your cost of goods sold is next up in that profit and loss statement. And after you take all that sales and from that number from your sales or your revenue and subtract the cost it takes to make that product or service or provide it, you then have your gross profit. Your gross profit is that number you have and how much you've made from your revenue from your business before you take into account those monthly expenses, okay? And as you can see at the bottom of this profit and loss statement, we're all in all going to be calculating your net income. So a few other things to note here. I kind of already went through the gross profit part, the cost of goods sold, But let's talk a little bit now about these expenses. You notice that your expenses are in a separate section here of the profit and loss statement. And that is because your expenses are typically not related directly to the revenue of your business, okay? Your expenses are things that you are going to most likely have to pay for regardless of how much revenue your business has. So expenses are those things like advertising, your rent, if you are paying for supplies, even inventory, your salary, or excuse me, your wages that you're paying employees, which we know can get extremely hectic, those payroll taxes that we have to dole out for those employees as well. So everything that is not directly related to the revenue of the business, but that is still something that your business is going to have to pay in a certain time period or repeatedly in a certain time frame, is going to be an operating expense. And that's kind of just your cost of doing business. You can see here for this computer solutions company that most of their expenses go into their officer salary, their wages, and then also into supplies and their utility bill. So that makes a lot of sense based on the type of company they probably are. If they're doing some type of computer sales or even repair, they're spending most of their money on supplies for that, supplies for those computers, and the wages to support their employees, okay? At the bottom of the profit and loss statement, you will also see everything a company owes in terms of interest and depreciation. Now, depreciation comes into play, and I'm looking here, do we have any companies who would deal a bunch with depreciation? Glorious, you is working for that contractor company and you're dealing with equipment. Depreciation usually occurs when you purchase an asset. Depreciation is that amount that it is devalued by over time. So if you have a piece of equipment or even real estate, it will depreciate over time. And you do account for that in your financial statements and records. But most of you all right now shouldn't be dealing with a bunch of depreciation. So this bottom part of the profit and loss statement is going to detail how much interest expense you owe at that current time. Now, interest expense comes typically on finance money. So if you started a small business and got a $20,000 startup loan for supplies and working capital, your interest expense would be notated here in that profit and loss statement. And then at the bottom here, you see when it was all said and done, after we take all of their revenue from Computer Solutions, minus their expenses and minus what they paid this year in interest on their loan, they then had $15,703 of net income. And that is money left over after everything we see here expense-wise, but not taxes. And yes, you would see depreciation actually on the balance sheet. And so you'll see that in just a few slides, Gloria. And I'll kind of explain why as well. And so we're just notating here the net income, or we also use the term net profit to describe what this number is. And as I stated, that is just the amount you have left after deducting all of your formal costs of doing business. And so now you spoke it up already. We are headed over to the balance sheet. And so the balance sheet looks a lot different because it's describing and showing you different things about your business. Let me get all of this pulled up here. Okay, great. So if we take a look at Computer Solutions balance sheet, in every balance sheet that you will see, the balance sheet starts by listing the assets of a company. Assets are everything that a company owns. Now, when you're looking at a balance sheet, you'll notice that your assets will always be listed in order of liquidity, okay? And we'll talk a little bit about liquidity a little bit down the line when we start talking about calculating ratios. But your current assets are those things that are either cash or that are very easily convertible to cash. So those are going to be all of your current assets. So in this case, Computer Solutions has a little bit of cash on hand, about $4,000, almost $5,000 here. And then you also have accounts receivable. Accounts receivable is very, very important for all of you who are selling services. Accounts receivable is where that money sits that you are waiting to receive within 30 days. So if you are selling a service and you usually bill or invoice your clients, that waiting period where you're waiting to be paid, that money sits in accounts receivable. But all in all, you have the asset section. That's where it shows everything that the business owns. You can also see inventory there if the company owns inventory. And then, Glorious, to your point, after we complete the current asset section, then you see some of those longer term assets that a company may own, such as equipment, as well as the depreciation that is accumulated over time for any equipment or real estate that that business carries. So depreciation usually sits in the asset category of a balance sheet, but you'll notice that it's a negative number. It's always going to be a negative number, but it goes into the assets category. That was always a weird thing that we learned in accounting, but that is the case. And I see Rosalind left a comment here that your expenses typically include industry training and some trips. That's very true. If you are a consultant of any kind, typically a lot of your expenses go into that traveling, entertainment, meals, everything that you need and that you're paying for on a monthly basis to provide that service. And then Rosalind also commented here, my commission and planning fees go into this category. Yes, great point. Past the assets here. So once you get past the assets and you total those out for your company, you're able to take a look at your liabilities. Now, this is the less fun part, obviously, of your analysis, but this is where you detail everything that your company owes, okay? Just like with the asset section, it's going to be the liabilities are in order of liquidity. So you have your current liabilities first, those things that you are going to pay off in a quick time period. This company, Computer Solutions, has about just under $30,000 that they will be paying out in their accounts payable. Accounts payable is kind of the same, or the opposite thing of accounts receivable. That is money that you are expected to pay out within the next month. So after you look at your current liabilities, you then can look at a company's long-term liabilities. Now, what happens when you get a bank loan for your business is on the balance sheet, when you are paying that loan off, some of that loan payment goes into the current portion of long-term debt. The rest of that bank loan typically will sit in that long-term liability section, which we have highlighted here as a bank loan payable. So that's a way for, and that is a way for, if someone is looking at your balance sheet for your company, it won't look as if you are completely sagged down by that bank loan, and it'll give a more accurate representation of how much you are actually paying in terms of that current portion of that debt. But overall, your liabilities are going to typically show if you have any loans out, if you owe any suppliers, or anything like that. Now, the last section of the balance sheet is where the equity goes. Equity is the owner's claim against the company's assets, but you can also think of owner's equity as what a company or what an owner has put into a business. So a lot of times when you're starting off, and if we do continue to work together and we have a one-on-one and I'm helping you all create your balance sheet, which is something that I do, I typically ask, how much paid in capital are you providing? So your paid in capital on this equity, in this equity section, is showing how much the owner has put in. The retained earnings shows how much the owner has sitting available to claim for themselves. And then the owner draw is how much the owner has taken from the company and drawn for themselves. So one thing I want you all to notice and remember as you all get started on creating your own financial statements is that when you're looking at a balance sheet, every time you have a balance sheet, your assets are always going to equal out to your liabilities and equity. So for computer solutions, the total assets are 233,930, and that's the same number you see down there at the bottom for total liabilities and equity. Anybody have any idea why that might be the case? So the reason that those two numbers will always match up is very, very simple. Every asset that the company owns was purchased through a liability or owner's equity from you. So if that number for some reason does not match up in your balance sheet for assets and liabilities and equity, then you know that there is something incorrect in that balance sheet. Because if the company owns an asset, it needs to be supported by either the debt or some type of liability or through owner's equity, and it needs to be displayed there. So those two numbers will always match up. Before we move on to part 2, which is kind of going through the differences between cash and accrual accounting systems, did we have any questions I could answer about that brief explanation of the profit and loss and balance sheet? All righty. Well, and if anyone does have a question that pops up later, of course, feel free to shout it out or type it in the chat as well. Now let's go ahead and move on. This section is going to be very, very brief because there is a standard in terms of what type of accounting system to use, but there are 2 different major accounting systems that are respected and acknowledged, okay? We have cash accounting and accrual accounting. Now, I know you all have heard of the company Enron and that big scandal from way back when, but this section it's not a warning, but it's something I want you all to be aware of when you are keeping up with your accounting records. What cash accounting is, or how cash accounting works is, simply put, you record the value of that transaction or how much you made when the cash comes in the business or comes out, okay? So cash accounting is very, very simple. It is the most simple accounting system because you simply put, when you transact a sale, you say that you got that cash. It's very simple. So when a transaction happens, you record the value of that transaction immediately, okay? Now with accrual accounting, you actually record the value of the transaction at the time of the transaction, but it's not necessarily when the cash actually is coming in or out, okay? So accrual accounting, it gives you a little bit more accurate representation of a transaction because you are reporting it at the time of the transaction, but you're not reporting the cash as flowing in and out until it actually does. With cash accounting, you're reporting a transaction as complete, no matter if there's accounts receivable, accounts payable, it's just when a transaction occurs. But with accrual accounting, it's a little bit different. Let's use this graphic to kind of display the difference between the two. In cash accounting, you get the supplies, you pay for them, you sell the item, you get paid for the item. Now, this might seem like the best way to go. Cash accounting, it's easy, it's simple. But this cash accounting only works in an extremely perfect accounting and financial and small business world, which we know as small business owners is seldom the case. So there may be some times where your transactions go specifically in exactly like this. And if you're selling a product, that may be the case, that typically it is a one and done transaction or a same time frame transaction. But what tends to happen and what accrual accounting accounts for is that those nuances in the transaction. So let's say you're getting supplies, okay? The accrual accounting system actually is accounting for how you're paying for those supplies. It actually also accounts for how and when you get paid for those supplies. So when you're looking at cash accounting, it recognizes your revenue and your expenses only when that money is actually changing hands, But accrual accounting actually recognizes revenue when it's earned and when you actually are billed out for those expenses. So it is a more accurate representation of the financial transactions that your business is most likely going through. So because of that, we always tend to recommend companies to use accrual accounting. Most big businesses, corporations are forced to use accrual accounting now because it gets a little bit dangerous to use cash accounting because of all of the things that can be missed. Okay, so right now, if you have kind of been using cash accounting, that's totally fine. It's the simple, easy way to get started. But if you start to use QuickBooks or some type of accounting software, you will be using accrual accounting, and that will kind of automatically be the case for you. I see Rosalind has a comment. Her commissions are usually paid after the client returns from the trip. Exactly. So, and as a business owner, it would be nice if you could just use cash accounting, and then on that balance sheet, you would have, let's say that person was paying you $5,000 for that trip. If you use cash accounting, on that balance sheet, it would show $5,000 in cash. Okay. In accrual accounting, it would show that $5,000 in accounts receivable, okay, where it is, and give a better representation of how that money is flowing. So all in all, the big point of this section is that accrual accounting is going to best structure your business for a realistic outlook. And in terms of software I recommend, I definitely just have to give it to QuickBooks. We don't partner with QuickBooks, but one of my colleagues or several of my colleagues are certified QuickBooks teachers. And so I will say that I love QuickBooks, and not just because of that. I also use it and manage QuickBooks for another organization. And the ease of use of it, the features, the user interface is very easy to use, and they've just been around the block. One of the classes that Eleanor and I will be scheduling, hopefully in July, fingers crossed, will be a QuickBooks Basics class. My colleague is, like I said, a QuickBooks expert. So she will come in and kind of describe to you all the basics of that QuickBooks online account, some of the features in there, and kind of how to get started as well. But QuickBooks is good, but there's a bunch of different good accounting services. I can probably send you a list as well as a one-off, Rosalind. All righty. So before we wrap up and talk a little bit about the financial ratios today and how to calculate those for your small business, we're going to do a brief case study. And here we have a regular profit and loss statement. As we stated before and talked about, the profit and loss is going to show on a simple level how the business is doing, okay? You know, if a business has been existed for 5-6 years and still has negative net income, that's a red flag. If a company has a very, very high cost of goods sold, where it's more than 75% of the gross profit, the net sales, then we know they probably need to find a better way to get that product made. So there's a lot of different things that your profit and loss statement can show you. It obviously shows you how profitable a business has been, but you can use this profit and loss statement to make make decisions on pricing, how to maybe improve your margins, and even better control your expenses. Now, this is just a year-over-year comparison for Computer Solutions profit and loss. So we have 4 years to compare. But what you see is, don't these statements just look like a kind of big wall of numbers? A lot of times when I see financial statements, I know what I'm looking at, but there is a way to make statements a little bit easier to digest, and that's using a tool called Common Size Statement. All a Common Size Statement does is convert your accounts to a percentage. And you may also have heard the term percentage size statements, but the Common Size Statement is basically used to compare current periods with previous periods. And then it's also used to compare companies that are similarly sized in the same industry. So kind of gives you a baseline for comparison. So now when we add in those common size statements, it makes it a little bit easier to see some differences on a year-to-year basis. So let's take a look at the profit and loss comparison, and there's a few things we can note. If we look at the expenses as a whole, it looks like their expenses have actually they've actually stayed about the same. Oh no, I'm sorry, I was looking at the wrong number. And I'm like, I have this in my notes. What am I seeing that's different from my notes? The expenses are actually, when they started out their company, and we look at the right side and we look at the total expense line, which is $186,807. If we just had the numbers without those common size statements and we compare it year over year, obviously we would just see the total expenses increasing. And we would say, yes, the total expenses have increased. But if we look at these percentages for the common size statements, we'll see that the percentages, in terms of the percentage of income, the expenses have actually decreased from 47% when the company started, down 8% over this 4-year period to being only 39% of that total income. So using the common size statements can be very, very critical, especially when you start developing these financial statements, then doing those year-to-year comparisons, those become very, very helpful. So this company has done a decent job of decreasing its expenses while that business is still growing, because we do see that the gross profit number in terms of the actual number is up. We also see that the net income number at the bottom, they started off with negative net income, which it happens for some small businesses. We usually expect to see some type of profit at least by year 3. So they started off with a negative 2% on their net income, and then actually increased that net income about 4% to get out of the negative, to get it a positive 2% by the end of their 4th year. So overall, the business has done a good job of managing their expenses during their growth and also increasing their net income. But one thing I did notice negatively, and is up here in the cost of goods sold section. If we look at, let me move my chat over just a little bit. If we look at the total cost of goods sold, we see that it is increased year over year. Now, typically, if you're able to increase your net sales, it can get tricky. But if I am Computer Solutions and I'm doing an analysis of their profit and loss statement, I would definitely be looking at ways to decrease that cost of goods sold. Because if you are making more money in net sales, hypothetically, there should be ways to find suppliers that will give you more for that bulk if you're needing to purchase more. So looking at this profit and loss statement, we can tell that they're doing good with net income, they're doing good with managing expenses or decreasing them, but they may need to take a look at finding ways to decrease the cost of goods sold. All right, let's take a look at the balance sheet. And the balance sheet is, as we stated before, looking at financial information for a specific point in time. So as of December 31st, back in 2004, Computer Solutions had a balance of $233,930. So this is kind of providing you a snapshot of their financial position. Now, when you're looking at their balance sheet, what a balance sheet really shows you is the liquidity of that business. And I talked a little bit about liquidity earlier. Is anybody familiar with that term, liquidity? What liquidity is when related to small business, liquidity for a small business simply means how likely or how able are you as a small business owner able to cover your short-term financial obligation, okay? Liquidity typically refers to how easy it is for you to convert your assets, and we talked about current assets versus long-term assets, but how quick can your assets be converted to cash? We're going to now kind of move into using different financial ratios that can help measure the liquidity of your business, okay? But one thing you will see here, they have a bunch of money in accounts receivable, $106,000, which means that hopefully that they would be able to quickly access that money to turn into cash. So this business, it does not seem like it has a huge problem with liquidity, but we'll be able to see that here in just a second. Any questions about the balance sheet so far? Okay. So we already went over this information as well. Go ahead, Megan.
So like insurance, so if we're receiving money or my partner is receiving money through insurance, then that would primarily show up in accounts receivable, then the money that like, so his, if he's getting it, if he copay would come in, would be the cash part, and then the accounts receivable, the rest of it would be, that would be coming in through insurance, would be showing in the accounts receivable about what should be coming in.
Yes, that's exactly right. So that copay that you got directly goes right to cash. And when we say cash, we know it means, you know, it can be debit card cash as well in this time. But yes, so that copay will go there and you got it exactly right. The rest that you were waiting on goes in accounts receivable, which is accounts receivable is the account where, and we talk a little bit about this in every class, is managing your accounts receivable and getting paid on time. And there's a ratio that will kind of identify how healthy your accounts receivable is. And we'll talk about that here in just a few minutes. But great question, thank you. And we talked about this equation, but assets, which are everything that your company owns, your cash inventory, your accounts receivable, land, will always equal your liabilities, which is everything that you owe, as well as your equity, which is everything that the owner has put in, and those profits that are available. Now, this is just another 4-year comparison for Computer Solutions balance sheet with the common size statements in there as well. Their companies, the balance sheet is pretty healthy. What I wanted to note about their balance sheet was the difference in how much money is sitting in accounts receivable on a year-to-year basis. So obviously, as the company grows, the accounts receivable line also has increased, okay? You see, though, that the cash, they decreased the amount of cash that they have on hand. And that's because typically when a business first starts, they have more cash on hand as they're paying for things for the company. But as the business grows and has expanded and has that foundation now, they don't have or need as much of that cash on hand because most of that money is sitting in accounts receivable with their clients that they're currently working with. Other things to note here within their balance sheet, if we also do a comparison here of the net income, or excuse me, the liability section, you'll note that the bank loan or the long-term liability section where you see that bank loan payable, if you have a loan, that section in that long-term liabilities should always be decreasing, okay? You should be paying that balance down and you should see decreases in that bank loan payable. So if you're not seeing that, then that indicates that you're having some problems paying back your liabilities, and that can indicate some challenges for someone taking a look at those financial statements. So when it's all said and done, you want to try to, after you have compiled your financial statements, then you want to try to compare those with other businesses in your industry. And there's a few different ways that you can, a few different tools and resources that I have access to that can help you with some comparison and industry analysis for your financials. One of those is ProfitSense. We have a few different, all of these different tools here are tools that I actually have access to that I can assist with. But the first step would be to go ahead and create those statements, and then we can plug those statements in to these different online tools that we have, and we'll get back full reports on how your business stacks up and benchmarks against other businesses in the industry financially. And last part of our presentation today is going to give you some information and help us learn more about these basic financial ratios that you need. So we talked already about the financial management cycle, how to document past performance using those statements, how to analyze, and now we're talking a little bit more about how to analyze. But if we look at the financial operating cycle, everything is connected. So you start off by making sales, okay? Once you make those sales, your business has net income. All of that information from your sales and from that activity goes into the balance sheet as well. The balance sheet shows everything that your company owns and owes. And then let's say you do have a net income, which is that profit. This is where business owners and small business owners have a lot of risk, because when it's just yourself, you can be very tempted to take the wrong amount of money back into your salary. But where those profits should be going from the business is into new assets that will help you make more sales in net income, or to pay off a liability or some debt, or to pay distribution or your suppliers or other parts of that sales process, okay? And then hopefully with those profits, your assets will go up, your liabilities go down because you're paying off debt and distributors or any type of suppliers. And then the net worth actually does go down because you're using and putting that money back into another place, into the business. So let's jump into the ratios. Why do we use ratios in the first place? There's a lot of good reasons for ratio use, but the number one reason is to compare your financial performance now to previous years. But these ratios can also be used to compare your performance to others in your industry, and you use your ratios to measure yourself, okay? I always tell clients, when it comes to marketing, financials, any area of your business, you want to try to create clear-cut goals that are tangible that you can come back and check yourself on. So you can also use ratios to compare to things you have planned for your business. And then bankers and any formal lenders also use ratios to quickly, easily get information and do a quick financial evaluation for your business when it comes to lending. So this is an example of how a ratio is set up, but let's kind of actually talk about what that ratio is. So the first ratio that you will use for your business is the debt to equity ratio. And the debt to equity ratio, simply put, describes what percent of assets your company has financed through debt versus owner equity. So to calculate that equation, and I believe this is using the numbers from our computer solution example. We don't have enough time to kind of go through the full case study and do those calculations, but we know that Computer Solutions has a total liabilities of $155,406. If we divide that number and how much they owe, and we divide that by how much the owner has put in or there is available for that company from the ownership, we get a number of 1.9. Now, we don't really know what 1.9 means yet. One thing I'm going to provide to you all after class for your own ratio creation is a document that kind of shows what good percentages or what good numbers for ratios are and what too high is and what too low is. But overall, when you're looking at the debt to equity ratio, if it is too high, that means that the business has too much risk. The leverage is too big in its liabilities. So if a company has over, let's say, a 2.0 debt to equity ratio, then that means that they have a very, very high amount of liabilities versus how much equity is available there. So that means if I was a banker looking at that company would be very, very risky to lend any more money to because they are already extremely highly leveraged by debt, okay? If a company has a debt to equity ratio that is too low, then that means that the company is almost too safe and there's not enough risk there to equate a potential return. Now, I would definitely say that having a too low debt to equity ratio is a lot better than having one that is too high. Now, the standard for debt to equity ratios, anything above a 2 is going to be seen as high and having a little bit of risk. The current ratio is one of my favorites. It's also one of the bank's favorites because what the current ratio is showing us is related directly to liquidity. And what do the banks care about when they give us a loan? Can they get their money back? So the current ratio describes the percent of current assets versus current liabilities. So the debt to equity takes all of that debt you have and all of that equity into consideration, but the current ratio is only taking into consideration those current assets. And remember, we talked about it, and current assets are those things that are either cash or assets that you can quickly convert to cash, which typically include accounts receivable and inventory. And then it takes into account all of your current liabilities, okay? So this ratio, simply put, tells you how easily it would be able, how easily for you as a business owner would you be able to access cash for your business. And if that ratio is too high, then that means that your business is too highly leveraged on those current assets. It does not have, that means that your business obviously does not have enough long-term assets, which makes it almost too liquid, because if everything is leveraged in current assets, you don't have those long-term assets to pull from. So being a highly liquid business is not extremely risky, but there is benefits to having long-term assets as well. But then obviously if the current ratio is too low, then that typically means that you are trying to finance your long-term assets with short-term debt. And typically when that happens, it offsets your ratios, it offsets your finances because you're trying to finance equipment, real estate, and things that take longer time to pay off with short-term debt that is expected to be paid off in a quick manner. So oftentimes, and give me just 1 second to pull this up. Before I go to the next ratio. And then for this ratio, a standard healthy current ratio is typically between 1.5 and about 3.0, depending on the industry, which is why instead of me trying to give you all what the perfect ratio number is, I would love to talk to you all individually, learn a little bit more about your businesses, and then I can give you a better indicator about where your ratio should stand once we kind of do an industry comparison of that as well. But anything from 1.5 to 3 can be seen as healthy depending on the type of business. And then we finally have the quick ratio. This is another one that lenders like to use very often. Anything that shows liquidity, lenders love to see, because what a quick ratio shows is the percent of assets that can quickly be converted to cash versus all of your current liabilities. So we thought the current ratio was a good indicator of how liquid a business is, but the quick ratio can really simply tell you how much cash essentially you can have on hand at a given moment, or how quickly you can, or how much cash and how quickly you can have access to that cash in a given moment, because it literally only takes current assets, which is simply only cash, inventory, and accounts receivable. So that's only taking your cash and accounts receivable, because it's minusing any inventory if you have that, or subtracting any inventory. Divide that by just your current liabilities, which are just your current loan payments and any of those current debts that will be coming paid soon. And then that gives you your quick ratio. Now, if you have a high quick ratio, that means you have excess cash and you're not investing enough back into the business in some way, whether that be in inventory or whether that be in a long-term asset somewhere. But if you have a super high quick ratio, it doesn't mean you're doing anything wrong. It just gives you the opportunity to restructure and find better ways to use some of those current assets that you have. And I've had a client in the past who we were going through a financial analysis of their financial statements, and we pulled up the ratios, and they were excited about the quick ratio number. I think it was extremely high. It was 2 point something, but I just know that they had a bunch of cash on hand. They were excited about it, but I explained to them that it's great to have all that cash on hand, but what could you be using that cash for to make more revenue from the business next year? Okay. So just things to think about. And obviously, if your quick ratio is extremely low, then that means you have a shortage on cash and you are potentially over investing into inventory or something that you're investing into something that's not providing you with enough return currently on that asset. So a lot can be seen from some of these ratios. I don't think we have a lot of we don't have any, really product-based companies here, but the days receivable ratio is very, very important for those product-based companies because that shows the average number of days that customers take to pay you. Sorry about that. I thought I went backwards. So this actually, the days receivable ratio, I thought we were talking about the inventory ratio. I apologize. But the days receivable ratio is very, very extremely important for all of you service-based people because this is showing how many days it takes customers on average to pay you. Okay. If we look at this and the equation itself is just accounts receivable, you multiply that times 365 days for the year and divide it by sales and get that days receivable ratio. But if the days receivable ratio is too high, we know that you as the business owner need to try to find better ways or more ways to collect payments from customers more quickly. And if it is extremely low, then you are collecting payments quickly. And I don't think there's anything wrong with a very, very low days receivable ratio. This company, Computer Solutions, is taking 63 days on average to collect payment. And that's not to say there's anything wrong with that, but you want to try to get in that 30-day range. You should be collecting payments within 30 days, but very, very often it balloons out to this 60. And I'm just happy that for this company, it's not 90-day average. So the better you can develop those relationships with customers, the better your financial health of your business will be because your cash will be flowing the way it's supposed to be. And then we also have the days payable. Lenders also like to look at this. It shows essentially how quickly you're able to pay off your debt. And it takes the opposite of the accounts receivable. It takes the accounts payable, divides that by the cost of goods sold, and essentially tells how many days it takes you on average to pay your suppliers. Now, this is typically more related to product-based businesses because it uses the cost of goods sold and not the total of all of your operating expenses. But if you have a high days payable ratio, it means that you are taking a longer time to pay your bills. And obviously a low days payable ratio means that you are paying your bills quickly. And then finally, the inventory turnover ratio, which I was describing earlier. This describes how often your inventory turns over in a year. Like I said, you all don't really deal with a lot of inventory, but this is a great ratio for suppliers to look at because it gives them an indication of how fast you're moving through your inventory and also could also indicate how much inventory you're keeping on hand as well. And then the last ratio on here should be this return on equity ratio. This is a very fun ratio because it's showing you it's essentially showing you the rate of return for the amount of investment you have in your business. So it takes your net income you divide that by your total equity that you have in the business, and you multiply that by 100, and you get a percentage from this. So a high return on equity ratio means that your company has good profits compared to your investment, and it could be highly leveraged. So if you put in, so anything over, a 1% here means that you are getting more percentage-wise from your investment from that company. So if the return on equity ratio is low, that means that you're not profitable enough, or it could also mean that you are holding too much equity, okay? Which does happen in some cases, because when you're starting a business, and one of the things also I'll mention is creating, if you all are just kind of starting off with real financial statements, one helpful thing we could do in the future is create your financial projections or your pro forma statements. And when you do that, it's very, very important to make sure that the owner's equity or the draw or salary is adequate and fair to the financial structure of the business. Now, what do all of these ratios mean? A lot of different things. The ratios can help you determine how to make improvements to a lot of the different part components of your business. They can help you make decisions on working with suppliers, on doing deals, on getting different loans. But the ratios are in those two financial statements are going to be the basis of your financial strategy and structure for your small business. And just to wrap it up, I think we've touched on all of our topics today. We've talked about the profit and loss statement, the balance sheet. We've talked about cash versus accrual accounting. We went through our computer solutions case study, talked about the financial ratios, and I will wrap this up and see if there are any questions for me out here in the chat. And if there's no questions, I will pass it back over to Eleanor, and she will kind of give you all some information about our upcoming programs, and also tell you all about how she'll be following up. Thank you.
Yes, thank you, everyone. I just posted a link in the chat to some of the other resources that the library provides, some great databases. These are things that you can use remotely if you have a St. Louis Public Library card, or that you can come into the library and use regardless of whether you have a card or not. If you are remote, there are ways for you to get a St. Louis Public Library card, but also your local library might have some of them. So we have a couple of databases that you can search to find various information about potential customers, about potential competitors. And then we have a database called Gale Business Plan Builder, which is a step-by-step online planning tool that will walk you through the parts of a business plan and put it together in an attractive package. We've got a database for Gale legal forms, which may have some potential resources that could be useful to you. We also have a lot of free training via Gale courses and LinkedIn Learning, which was also known as lynda.com. So I put a link to our business resources there in the chat. When I send you the email with the link for the video for today, I will send some information about them as well. We also, as I mentioned earlier, have a program coming up about the first steps of starting and managing a business, which you are welcome to attend. So there's the link to that there if you are interested in registering. As Amina said, we are planning programs for the upcoming July, August, September quarter. And I'm also always interested, if there is something you particularly would like to see us offer, let me know and I'll see what we can put together for that. And that is a real brief summary of some of the resources you can access through the St. Louis Public Library. And thank you so much for joining. Oh, I see, Glorious. Yeah, trying to note down as much as you could and soak it all in. So when you have that video, if there's something you want to go back to, you'll be able to say, oh, I think that happened around the half-hour mark. Go into that video and get that refresh on that. And also, I will be if you're here today, you've got Amina's email address because I did not blind copy her in the invitation, so you can reach out to her, but I will include her email address as well in that follow-up email that will probably be going out next week. So